Hi, everyone. Thanks for joining me today. I'm recording a update for the new 2023 retirement plan limits, specifically the new 401k contribution limit and catch up as well. With this, I'm going to layer in, for those who haven't heard from us before, our retirement planning workshop as well. So thanks for joining. Let's get started. If you need a copy of our ADV, give us a call or shoot us an email. This is our team. That's me, fourth from the left, one of the founding partners of Warren Street Wealth Advisors, with my business partner there in the center, Blake. We're a true ensemble team, meaning that when you decide to work with Warren Street Wealth Advisors, you get all of us. All right, here it is. So for 2023, the IRS announced the new contribution limits for retirement plans. And for the majority of our clients, we're talking about 401ks. However, the limits are the same for 403b and 457s. So if you have one of those plans, this applies to you. Increase of $2,000. So it went from $20,500 in 2022 to $22,500 for 2023. So a nice $2,000 increase. Now, a lot of people ask, you are not saving into a 401k plan. Is it all or nothing? No, you can save anything between zero to this limit of $22,500. The reason why I'm sharing the retirement planning presentation in combination with this is so you can see how you can get there. So if you're not currently maxing it out, we encourage you to do so. Pick up a large tax deduction if you're using a traditional contribution limit as opposed to a Roth contribution. And then the catch up. So if you're 50 years or older, you can add another $7,500 in. So for your plan year, when you're turning 50, you can save 22,500 plus the 7,500 catch up. So 30,000 all in. And this I love, because in our business, it's the numbers are always changing, and it's hard to remember. But for this year, and it'll probably be this year only, 30,000 all in for those who are 50 years and older. Pretty clean. Simple deferrals went up by $1,500. The simple catch up went up by $500. SEP IRA is an increase of $5,000 to $66,000. Really nice for small business owners. And then the $500 increase for IRAs. So if you're not covered by a qualified retirement plan through your employer or through yourself, if you're self-employed, you can always save in an IRA. So that increase went up to $6,500, and then the catch up as well for 50 and older, $1,000. So no change there, same as last year. All right, so for retirement, I'm going to go through this real quick. We have, by the way, if you're watching this, you want to watch further versions. If you get to our YouTube channel, we've got a library for the last few years. We've been recording these events, and there's all sorts of free content there to watch. Attend the workshop, read the retirement handbook, take a look at our toolkits available in this slide show, as well as on our website. So if you go to Who We Serve, there's all these resources available on our website. Talk about what you are working for, the vision. Next steps if you want to talk to us about any of this, and finally, get ready to retire. So the handbook, let's look at this. Have a plan. Seriously, have a plan. No surprise. Pay off your debt. So really, we're talking about credit card debt here, or high interest consumer debt. If you have a mortgage, not an issue there. Car loan, same. If you try to retire, a lot of clients try to pay off their car before they retire. Less debt is good, but I wouldn't take a distribution from a retirement account to pay a bunch in tax in order to pay off a car loan that might be somewhere between 2% and 5%. And every 7 to 10 years, our clients are needing a new vehicle. So there's a really high probable chance that you will need a new car in retirement. So I wouldn't rush to pay it down unless it's higher than maybe 5%. Then yeah, it does make sense probably to take money from savings and pay that down sooner than later. Budget it out. If you've never created a budget, spend 15 minutes, yellow pad, use the template we have, Excel, Google Sheets, whatever you need to do. It's like exercise, whatever one you're willing to do is better than better than nothing. And so same for the budget. Spend about 15 minutes going through and identify how much you need to support your current lifestyle. And then that will help you plan for retirement as far as needing how much money to support where you want to spend your money to enjoy. build up emergency savings. 4 to 6 months is a good rule of thumb. 6 months is very common. So we like to see that. So if you do the budget and it's $5,000, easy math says $30,000 in savings. That's not invested. If you want to take some of that and go a higher interest savings account, online savings, you can look at bankrate.com. They're a third-party website. It'll help you quickly see some high interest savings accounts. Also, I-bonds are becoming more and more popular. We're seeing high interest rates there. You can do $10,000 per year per individual in the household, and they're paying upwards of 6, 7, 8%. You do need to wait 6 months. We do not offer these for our clients, so we just help our clients at least navigate that path should you go that route. But it is something worth looking at for short-term cash. Save, save, save. 401ks, 403b plans. The theme of today is high $2,000 increase on the personal deferral, plus another little bit on the catch-up, getting you to $30,000 if you're 50 and older. Easiest way to save is in a 401k, 403b, 457, some sort of qualified retirement plan, a defined contribution plan, DC plan, and save for retirement. You get a big tax deduction this year, and you're setting aside money that is tax deferred, and hopefully in retirement at a lower rate than what you're paying today, possibly moving out of state, which is popular, and I'll talk about just here in just a moment. Weigh your Social Security options. I have a slide for that, so we're going to move forward. And of course, yes, have a plan. We said it again, have a plan. So Social Security, ages to claim, 62 to 70. Full retirement age for everyone listening is 66 to 67. They made a transition, depending on the year you're born in the 1950s. That got deferred out to age 67. It's why a lot of people with a birth year in the 50s, it's really, I think it's 1954 to 1960s when they changed those dates, but it's 66 in 2 months, 4 months, 6 months, 8 months. They did that to gradually increase the retirement age to 67, which was a smart way of doing it as opposed to just a hard cutoff date. So that worked. Largest benefit age is age 70. So every year you wait, you get an 8% increase in benefit. It's a linear benefit. So every year you wait, 8% increase. It's a real nice raise for retirement income from Social Security. So if you can wait, we recommend you do. A lot of our clients are living into their 90s, and if you think you're going to live into your 80s, which is becoming more and more commonplace, waiting until full retirement age will provide you a lot more retirement income benefit. And then past that, if you're healthy at 66 and healthy at 67, and you have other sources of income to make your, to make ends meet, then waiting till 70 does actually pay out more money to you in retirement should you live to be into your 80s. And if you have a high probable chance of living into your 90s, it really makes a lot of sense. Beyond age 70, there's no increase in benefits, so it doesn't make sense to wait any longer. So at 70, collect. Things to consider: collecting while working depends on your tax situation, but a lot of our clients do not. Health and anticipated longevity. If we knew how long we're going to live, this would be a very easy decision on when to take Social Security. But if you're healthy, take it later. If you're not, take that into consideration, and possibly collecting at 62 is the best thing for you. Spouse benefits, yes. So spousal benefits, it does play a big part into the decision. So when we run an analysis for a client, which is part of our standard of care for all our clients. So if you're a client of ours, we can do this for you. If you're listening and you have questions about Social Security, ask us. We'll be happy to run some scenarios for you. And then is Social Security going away? No, I don't think so. This is my personal opinion. I think what will happen is the same thing we will do. I've said this many times before, but sharing with you maybe for the first time. But what we'll do with Social Security as a country is defer the date. So they did this before, 66 to 67. We will reduce the amount of benefit. So let's say your projected benefit was 1,800. Now maybe it's 1,760. And then we'll also raise taxes to help fund these future obligations. What I think will happen, most likely just the way any employer changes benefits, it changes it for new employees. And I think the Social Security Administration will do the same. They'll change the benefits for new payers. That way, if you've been paying into this program, and let's say you're 54 years old and you've been paying into it for a long period of time, you're getting ready to plan your retirement, I don't expect many changes to your benefits. And this is the same way we shore up a client's plan for retirement if they're not quite ready. Defer the date, spend less. So instead of $5,000 a month, maybe it's $4,700 a month from all retirement income sources. And then we can't raise taxes, but what we can do is we can save more. The theme of today is deferring more into your retirement plan with the new limit increase for 2023. So if you can increase that, that's essentially what the Social Security Administration would do by collecting more tax to put more money into the pot. We would encourage you to do the same. So save more. That's Social Security. I know that's quick, but there's a lot to be thought of there, and it's a large benefit for retirement. So it is worth weighing all your options as opposed to just collecting early. Toolkit, assets and liabilities, take those two, subtract it at your net worth. Really easy sheet here as well. On the budget, I said 15 minutes. I would do another 15 minutes on this. Go through, if you already have, some of these aggregator tools like Mint, I know is one that I've heard about clients using, but basically see everything in one place. If you don't have something like that already, you don't have a financial plan with us or elsewhere, this is a really easy thing to do. Just list everything in one place. I also encourage you to let family members know and loved ones know where this document might be, if it's in the safe or it's with, Social Security cards or birth certificates. If something were to happen to you, this would be an easy place for family members to figure out what mom and dad had or figure out what you had. And it's a Wells Fargo account, a Chase account. Maybe you have a small balance at, an E-Trade or a Robinhood or some stock account that they might not even know mom and dad had. And so this would be an easy start for the family members to find what accounts you have and how to proceed with those should something happen to you. That's that. Budget, 15 minutes, same thing. This is all available on our website, warrenstreet.com. Just go to who we serve. We have some resources there for you to use. Build your vision, very important. Start thinking now, start writing, start talking about what it is you want to do with this new time once you are retired and you've maxed out your 401k for many years, and now you're trying to figure out what to do with the money that you're going to be taking out. Hobbies, family time, travel, sports, learn, volunteer. Travel is a big one. And then where you live in retirement also has a huge weight to the decision of are you prepared enough to retire or should you defer the date? So we see quite a few of our clients. Warren Street is based in Southern California, and our team of 9 is all located throughout SoCal. We do have one individual back in New York, Justin, but the reality is moving out of Southern California or even New York to rural areas, what we see here is the dark blue with the lowest cost of living being more affordable. So if you're on the hump and you're not quite sure if you are retirement ready, we've seen clients downsize in retirement, taking the equity out of their home here in Southern California or wherever they live, paying cash for something, either getting rid of a mortgage or creating additional cash through the excess equity they have from their home purchase. And that has been enough to get them to the finish line to retire confidently and comfortably, which is our goal as your advisor. But some reasons to stay in California: beaches, parks, the diverse culture, entertainment, obviously family and friends if you live here now, and the medical care. That's something we're hearing more and more about. The medical care outside of California is good, but a lot of the providers are not available, such as Kaiser in all 50 states. And so that has been an issue for clients. And also the location at which those providers are at. We hear our clients having to drive long distances to get the care that they desire. So everything's not totally wrong with California, and we hear a lot of complaints. And as a resident all my life, I do like to remind myself and our clients of all the good reasons to stay. Last 5 here, muni bonds. California is the largest municipal bond market by issuance. So you pick up some tax advantages there if you own California munis outside of a retirement account. So that is something to consider. A lot of large employers are offering part-time work with medical and retirement benefits. So you're seeing more and more flexibility here for part-time work and picking up some benefits that were not available prior. Property tax, a lot of clients are familiar with this, but it's become even simpler and easier to carry low tax basis to other counties throughout California now. And that is a huge advantage to staying in California, is if you've been in your home for a long period of time and you have a low tax basis, to carry that into your new home in California. So if you have questions about that, please let us know. Finally, the weather, and of course, In-N-Out. And yes, I know In-N-Out is in more than one state, but they're spreading through the Southwest region pretty quickly, so that's exciting. Next steps, if you want to work with us, this is how we work. We do offer a free complimentary consultation. That's 1 hour with one of our advisors on the team. Myself, Blake, Lynn, and Emily all accommodate those meetings. So you have 4 options there. If you decide to move forward, we prepare an engagement letter, and you have plenty of time to discuss what it would look like working with us. Then we'd go through discovery, talk about all your plans, talk about your plans and your goals, put that together, and then come up with our solutions that we would then implement. We manage investment portfolios in-house. I'm going to go through this quickly because there's a lot here, but I just want to point out that we do build our portfolios and maintain them for them here at Warren Street, and that is something we are proud of. As a small firm, it's not common. We also offer custom indexing where we can take an ETF and unwrap that and own the individual securities directly. You get to own the securities directly. You pick up some possible tax advantage you would not receive if you owned the ETF or mutual fund directly, as opposed to individual securities. And then finally, you can do a lot of custom portfolio constraints. So if you wanted to, let's say remove tobacco from your portfolio, you could add that customization through custom indexing. So it's kind of cool. Eligibility, we do have some eligibility requirements. I talked about the benefits there. So let us know if you have any questions on that. Again, also resource available on our blog, on our website, custom indexing. You can get through it through onestreet.com and look at investing. And there's a section there to learn everything it is you would want to know about that. Our fees, we like to hold this out because a lot of firms don't show what they charge, but we try to be as honest, open, and transparent as we can. So this is our annual percentage. If you reach our $5,000 per year engagement, we offer standard of care for all of our clients. So once you're at that threshold, there isn't anything that we won't do for you that does not fall under this standard of care, which is tax return review, retirement projections, which I've talked about earlier, investment account recommendations, that's 401k, 403, 457, stock portfolios. If you have investments, even if they're not under our discretion to trade and manage, we will provide recommendations for you to take back and implement to any type of account that you own. Estate planning and review and coordination. We don't do estate planning in-house, but we can refer you to an estate planning attorney if you need one. The coordination is really important because we've seen estate plans, for you, it's really one time you have to do it and then a review or an amendment. But we've seen between our team hundreds of these come through. And so we know what to ask, know what to talk about, know what to think about when you're going through this process. So we like to be a part of that conversation and even be on that first call with the attorney we either introduce you to or an estate planning attorney you have, just to make sure that it's getting done correctly. Because at this point in the process, we know a lot about our clients' lives, families, goals, objectives, expectations. It's easy for us to help shape that conversation with the attorney. So that's why we put it here as well. Home purchase refi assistance, pretty standard stuff we've been doing forever. And with that comes mortgage and debt evaluation. Benefits, we can review life and health insurance reviews. Net worth statement. So we mentioned earlier in our plans, you'll have a net worth statement that you'll have access to that we maintain. Financial planning portal, where you can log in and see everything at any time, both on the investment side and on the financial planning side. And then the last item, which is a huge benefit that we get a lot of good feedback from, is this can be an overwhelming process. So we put together a priorities calendar for you, and we'll just work through this diligently as far as our implementation stage for solutions that we come up with you, because some of these items do take quite a bit of time. We don't want to feel like an overwhelming process, and then we'll just rank them in order of importance. And that way, if things change, we can update that calendar as well. That is our standard of care for all of our clients. So here we are, we're at the end. Retire, enjoy all life has to offer. If you want to book a consultation, talk about the new deferral limits that we covered here today, feel free to schedule that. If you're an existing client, thank you for your continued trust in Warren Street. We appreciate it. It's been a challenging year, and we've stayed busy working with you to keep us on track towards our goals. And we thank you again for that. But that's it. That's the deferral limit update. So if you have any questions, feel free to reach out. And thank you for joining me today. And happy holidays and enjoy the rest of your day. Thank you. Bye-bye.